I now propose to provide an assessment of growth and inflation. Let me take up first global growth. Global growth is expected to remain steady in 2024 with heterogeneity across regions. Though global trade momentum remains weak, it is exhibiting signs of recovery and is likely to grow faster in 2024. I would like to mention that, I am making several statements, and the supporting data for all the statements that I am making, all the sentences that I am reading out, the supporting data is provided in the footnotes. So therefore, those of you who are interested can refer to the footnotes for the backup data in support of whatever statements I am making here. So let me just restart so that there is continuity. Global growth is expected to remain steady in 2024 with heterogeneity across regions. Though global trade momentum remains weak, it is exhibiting signs of recovery and is likely to grow faster in 2024. Inflation has softened considerably and is expected to moderate further in 2024. Financial markets are volatile as market participants adjust their expectations on the timing and pace of rate cuts by major central banks, who in any case remain cautious against premature easing in their fight against inflation. Amidst the current headwinds, elevated level of public debt is raising serious concerns on macroeconomic stability in many countries. Now, this is a new point which I am just introducing, which I am talking about in this MPC, because this aspect, I think, is an important aspect and it will impact the future trajectory of global financial stability and global financial system. So therefore, this point I thought I must mention here as a part of the monetary policy statement. Now, amidst the current headwinds, elevated levels of public debt is raising serious concerns on macroeconomic stability in many countries, including some of the advanced economies. Global public debt to GDP ratio is projected to reach 100% by the end of this decade. The public debt levels in advanced economies, in fact, are much higher than those in the emerging market economies. The challenges of debt sustainability in an environment of high interest rates and low growth at the global level can become new sources of stress. Reducing debt burdens is necessary to create fiscal space for new investments in priority areas, including green transition. Now, in this context, so far as India is concerned, going by the budget which has now been presented, I think government is adhering to a path of fiscal consolidation, and as per the projections made by the International Monetary Fund also, India's that is general government, the debt of both central and state governments are expected to moderate in the years to come. This is just a point of information to put things in the context. Domestic growth. Domestic economic activity remains strong. The first advance estimates placed the real gross domestic product, that is real GDP growth, at 7.3% for 2023-24, that is for the current year, making this the third successive year of growth of above 7%. Going forward, the momentum of economic activity witnessed during the current year, that is 23-24, is expected to continue in the next financial year also, that is in 24-25. Agricultural activity is holding up well despite lower inflation, lower reservoir levels and delayed sowing. Rabi sowing has surpassed last year's level as well as the normal acreage. The allied sector is also expected to provide major support to agriculture with continued momentum in horticulture and fisheries. Industrial activity is gaining steam on the back of improving performance of manufacturing. The early results of corporates in the manufacturing sector remain upbeat, driven by higher profit margins. The Purchasing Managers Index, that is PMI for manufacturing, is displaying expansion along with strengthening of future activity index. Services sector activity is expected to remain resilient on the back of strong domestic demand and stable global prospects. The PMI services increased significantly in January, that is January this year, suggesting continuing strong expansion. The buoyant demand for residential housing, coupled with increased thrust on government capex, is expected to propel construction activity. On the demand side, improving employment conditions and moderating inflation, together with a rebound in agricultural activity, should push up household consumption. Rural demand continues to gather pace, strengthening farm-level activity as reflected in declining Mahatma Gandhi Narega demand, and the extension of Pradhan Mantri Garib Kalyan Anna Yojana should further support rural consumption. Urban consumption remains strong on the back of improved income levels. Investment cycle is also gaining momentum, is gaining steam, aided by sustained thrust on government capital expenditure, increased capacity utilization, rising flow of resources to the commercial sector, and policy support from schemes such as production-linked incentive. Revival in private corporate investment is also underway. Our survey suggests that investment intentions of private corporates remain upbeat, and both services and manufacturing firms are optimistic about overall business conditions. Next, net external demand is also improving with narrowing merchandise trade deficit. Now, taking into account all these factors into consideration, real GDP growth for 2024-25, that is the next financial year, is projected at 7%. I repeat, real GDP growth for 2024-25, that is next financial year, is projected at 7%, with Q1 at 7.2%, Q2 at 6.8%, Q3 at 7%, and Q4 at 6.9%. The risks are evenly balanced. Let me now turn to inflation. Headline inflation moderated to an average of 5.5% during April to December 2023 from 6.7% during the whole of 22-23. Food price inflation, however, continued to impart considerable volatility to the inflation trajectory. In contrast, the deflation in CPI fuel deepened and core inflation moderated to a 4-year low of 3.8% in December. The decline in core inflation continued to be broad-based, with inflation remaining steady or softening across its constituent groups and subgroups. The inflation trajectory going forward would be shaped by the outlook on food inflation, about which there is considerable uncertainty. Adverse weather events remain the primary risk, with implications for the Rabi crop. Increasing geopolitical tensions are also leading to supply chain disruptions and price volatility in key commodities, especially crude oil. On the positive side, the progress in Rabi sowing has been satisfactory and augurs well for the season. Prices of key vegetables, especially onions and tomatoes, are registering seasonal price correction. Taking into account these factors, CPI inflation, that is consumer price headline inflation, is projected at 5.4% for the current year, that is 23-24. So that is for the current year 23-24, we are projecting CPI inflation at 5.4%, with the fourth quarter, that is the current quarter, projection of 5%. Now, assuming a normal monsoon for the next year, CPI inflation for the next financial year 24-25 is projected at 4.5%. I repeat, CPI headline inflation for next financial year 24-25 is projected at 4.5%, with Q1 at 5%, Q2 at 4%, Q3 at 4.6%, and Q4 at 4.7%. The risks are evenly balanced. Now, what do these inflation and growth conditions, what do they mean for monetary policy? Let me try and answer. Inflation has seen a significant moderation from the highs of the summer of 22. That is the summer of 2022. Over the last 2 years, monetary policy has prioritized inflation over growth, undertaking calibrated increase in policy repo rate by 250 basis points and withdrawal of stimulus measures. Monetary policy was supported by proactive supply-side measures by the government. That said, the job is not yet finished, and we need to be vigilant about new supply shocks that may undo the progress we have made so far. Headline inflation has remained high and has seen considerable volatility, moving in a range of 4.3% to 7.4% during the current financial year. Recurring food price shocks could interrupt the ongoing disinflation process, with risks that it could lead to de-anchoring of inflation expectations and generalization of the price pressures. Adding to these are the renewed flashpoints on the geopolitical front, including supply chain disruptions. Importantly, the CPI inflation target of 4% is yet to be reached. Monetary policy in the midst of these lingering uncertainties has to remain vigilant to ensure that we successfully navigate the last mile of disinflation. Now, the last mile of disinflation is always the most challenging, and that has to be kept in mind. Stable and low inflation at 4% will provide the necessary bedrock for sustainable economic growth. This point is very important, because if we are interested in the long-term growth of our economy, then we need a regime of low and stable inflation. That is why we remain focused on bringing the inflation, to align the inflation to the target on a durable basis. I would now like to focus on the liquidity and financial market conditions, about which there is a lot of interest in the financial markets and also elsewhere. After remaining in surplus during April-August 2023, system-level liquidity turned into deficit from September after a gap of 4.5 years. Adjusted for government cash balances, potential liquidity in the banking system is still in surplus, and that may surprise you. But adjusting for government cash balance, potential liquidity in the system is still in surplus. During December-January, the Reserve Bank proactively injected liquidity through both the main and the fine-tuning repo operations to ease liquidity tightness in the system. With government spending picking up and augmenting system-level liquidity, I must mention that in the recent, particularly in the second fortnight of January, government expenditure was sustained. But I think there has been a significant pickup from the second fortnight of January, and also we are witnessing the same in February. And so with government spending picking up and augmenting system level liquidity, the Reserve Bank undertook 6 fine-tuning variable rate reverse repo auctions, that is VRRR auctions, during February 2 to February 7, 2024 to absorb surplus liquidity. Financial market segments have adjusted to the evolving liquidity conditions in varying degrees. While the short-term rates have fluctuated, long-term rates have remained relatively stable, reflecting better anchoring of inflation expectations, as indicated in the softening of term spread in the government securities market. In the credit market, however, monetary transmission remains incomplete. Let me reiterate, and this is very important, let me reiterate that our policy stance is in terms of interest rate, which is the principal tool of monetary policy in the current framework. Our stance of withdrawal of accommodation should be seen in the context of incomplete transmission and inflation ruling above the target of 4% and our efforts to bring it back to the target on a durable basis. So far as liquidity conditions are concerned, these are being driven by exogenous factors which are likely to correct in the foreseeable future, aided by our market operations. On our part, the Reserve Bank remains nimble and flexible in its liquidity management through two-way main and fine-tuning operations in both repo and reverse repo. So you would have noticed we have done two-way, market interventions, both repo and now reverse repo. And we have been very nimble even during one particular day, like yesterday and day before. On a single day, we conducted 2 VRR auctions on a single day. That was seen yesterday and day before. And that goes to show that we are nimble and swift in our response to the evolving liquidity conditions. Now, I would like to emphatically state here that we will deploy an appropriate mix of instruments to modulate both frictional and durable liquidity so as to ensure that money market interest rates evolve in an orderly manner and financial stability is maintained. The reversal of liquidity facilities under both SDF and MSF, even during weekends, which we announced in the last, that is in December policy statement, has actually facilitated better funds management by the banks. As of February 7, 2024, the Indian rupee has remained stable compared to both its emerging market peers and even a few advanced economies. In terms of coefficient of variation, the Indian rupee exhibited the lowest volatility in 2023-24 as per the data available between April to January of the current financial year. Now this I am saying compared to the corresponding period in the previous 3 years. Let me reiterate that the exchange rate of the Indian rupee is market determined. Its relative stability in the recent period, despite a stronger US dollar and elevated US Treasury yields, reflects the strength and stability of the Indian economy, its sound macroeconomic fundamentals, financial stability, and improvements in India's external position, particularly the significant moderation in current account deficit, comfortable foreign exchange reserves, and return of capital flows. Now, the confluence of all these factors put together have ensured that the Indian rupee, the exchange rate of the Indian rupee, has remained fairly stable over the last 1 year or so. I would now like to touch upon financial stability. The domestic financial system remains resilient with healthy balance sheets of banks and financial institutions. The financial parameters of non-banking financial companies, that is NBFCs, are also improving in tandem with those of the banking system. Good governance, robust risk management, sound compliance culture, and protection of customers' interest are of paramount importance for the safety and stability of the financial institutions as well as that of individual financial institutions. The Reserve Bank lays great emphasis on these aspects. We expect the regulated entities of the Reserve Bank to accord the highest priority to these functions. External sector is the next area on which I would like to touch upon. India's current account deficit declined sharply to 1% of GDP in the second quarter of 2023-24, that is second quarter of the current financial year, from 3.8% in the second quarter of the previous year. Going ahead, the net balance under services and remittances is expected to remain in large surplus, partly offsetting the trade deficit. India's services exports remained resilient in October to December this year, driven by software, business and travel services. Moreover, with around 10.2% share in world telecommunications, computer and information services exports, India is a significant player in the world software business. According to the World Bank, with an estimated $135 billion inward remittances in 2024. I repeat, the World Bank estimates the inward remittances for India to be in the order of $135 billion in 2024. Now with this, India would remain the largest recipient of remittances globally. Thus, current account deficit for both 2023-24 and 24-25 is expected to be eminently manageable. On the financing side, net foreign direct investment stood at $13.5 billion in April to November 2023, as compared with $19.8 billion a year ago. Foreign portfolio investment, that is FPI investment, witnessed a sharp turnaround during 2023-24, that is current year, up to February 6, with net FPI inflows of $32.4 billion as against net outflows of $6.7 billion a year ago. Net accretions to non-resident deposits and net inflows under external commercial borrowings were also higher during the current year. As on February 2, 2024, India's foreign exchange reserves stood at $622.5 billion. Vulnerability indicators suggest greater resilience of India's external sector. We are confident of comfortably meeting all our external financing requirements. I shall now announce certain additional measures, and some of these measures are very important, so I request your patience. The first measure I wish to announce is review of the regulatory framework for electronic trading platforms. The Reserve Bank's extant regulatory framework for electronic trading platforms was issued in 2018. In view of the subsequent developments in markets, products and technology, etc., a revised regulatory framework for these electronic trading platforms will be issued for stakeholders' feedback. The next announcement relates to hedging of gold price risk in the OTC market, that is over-the-counter market in the International Financial Services Center, IFSC. In December 2022, the Reserve Bank had permitted resident entities to hedge their gold price risk in recognized exchanges in the IFSC. It has now been decided to allow resident entities to hedge the price of gold. Now let me just read it again. It has now been decided to also allow resident entities to hedge the price of gold in the OTC segment in the IFSC. This will provide more flexibility to resident entities in hedging their exposure to gold prices. The next announcement is actually very important and has far-reaching consequences. Particularly, it is something which will really benefit the small borrowers from the lending sector, from banks and other entities. At present, and that relates to key fact statement, that is KFS for retail and MSME loans and advances. At present, the loans and advances availed by borrowers, apart from including the rate of interest, also include other fees and charges such as the processing fees, documentation charges, etc. So as a result, what happens is that the customer, he knows that the loan carries an interest of so much percentage, but then there are other charges and fees, etc., which he pays upfront. Now that also needs to be loaded into the actual interest rate. So the customer has a clear idea that what is the actual annualized interest rate that he pays. And this is something on which, as you are aware, as I have said a little earlier, customer centricity is something on which the Reserve Bank lays a great emphasis in the overall public interest. Now, to enhance transparency in disclosure of such information, that is information on various charges, fees, etc., the Reserve Bank had mandated certain categories of lenders to provide the borrower a key fact statement, that is KFS, containing essential information such as all-inclusive annual percentage rate and recovery, and also details of the recovery and grievance redress mechanism. The requirement of the key fact statement is now being extended to cover all retail and MSME loans. This measure will lead to enhanced transparency in lending and will enable customers in making informed decisions. The circular will be issued separately. Obviously, we have to give some time to the banks to comply with these requirements because quite a few preparatory action needs to be taken at the end of the banks. The next announcement relates to enhancing the robustness of AEPS. Aadhaar-enabled payment systems, that is AEPS, has played an important role in financial inclusion by enabling customers to make digital payment transactions through service providers such as business correspondents. Given their significance, it is proposed to streamline the process for onboarding of AEPS service providers and introduce some additional fraud risk management measures. This measure will further strengthen the security of the AEPS system and enhance its robustness. The next announcement relates to principle-based framework for authentication of digital payment transactions. Over the years, the Reserve Bank has proactively facilitated introduction of various mechanisms such as additional factor of authentication for securing digital payments. While no particular mechanism was specified by the Reserve Bank, SMS-based OTP, that is one-time password, has become very popular. With technological advancements, however, alternative authentication mechanisms have emerged in recent years. Therefore, to facilitate adoption of alternative authentication mechanisms for enhancing the security of digital payments, it is proposed to put in place a principle-based framework for authentication of such transactions. The next and the final announcement, the last announcement, relates to introduction of programmability and offline functionality in central bank digital currency pilot projects. The CBDC, that is Central Bank Digital Currency Retail, the CBDC retail pilot currently enables person-to-person and person-to-merchant transactions. It is now proposed to enable additional functionalities of programmability and offline capability in CBDC retail payments. Programmability will facilitate transactions for specific or targeted purposes, while offline functionality will enable these transactions in areas with poor or limited internet connectivity. I now propose to conclude. The Indian economy is making confident progress on a strong, sustained and transformative growth path. Domestic and international investors are reposing greater confidence on India's economic prospects. In our assessment, the current setting of monetary policy is moving in the right direction, with growth holding firm and inflation trending down to the target. Therefore, much has been achieved, but we must remain vigilant. Policy making during uncertain times has to be based on a continuous assessment of the incoming data and its implications for the evolving outlook. We reaffirm our commitment to bring down inflation to the target of 4% in a timely and sustainable manner. Price and financial stability are the foundations for strong, sustainable and inclusive growth. Our endeavor all along has been to take a holistic approach to keep the economy in balance. We must not only preserve the hard-earned strength and stability of the Indian economy, but also build on this further for a long haul of higher growth with price and financial stability. In the current environment, what Mahatma Gandhi said long ago remains very relevant, and I quote, "I am moving cautiously, watching myself at every step. I repeat, I am moving cautiously, watching myself at every step. But there is the fixed determination behind every act of mine." Thank you. Namaskar.
Okay, well, there hasn't been much of a giveaway in terms of dovishness. It's very, very even-handed, at least as it sounds to me, and I'm being guided by how the yields have moved. The yield in the morning had even gone to 7.04, the 10-year, in early morning trades. And then before the speech, it had come up to 7.08, now at 7.09. So the market's expectation that there could be a hint that the withdrawal of accommodation will go away is not realized. In fact, the governor seems to have delinked liquidity and withdrawal of accommodation. He says withdrawal of accommodation should be read along with their goal of getting inflation to 4%. So it's not clearly the fact that they provide a little bit of liquidity should not be confused with the stance of withdrawal of accommodation. Stance should be seen along with the mandate of 4% inflation. So unless they see that coming down towards 4, looks like they will not change their stance, and maybe that is why the market is a tad disappointed. Well, 7.09 is not much, not very different from 7.08. The big positive is that they've brought down the inflation forecast for the current quarter. Jan, Feb, March was originally 5.2, they have brought it to 5, but they've not changed the full year inflation forecast. It remains at 5.4. But for the current quarter, it has been brought down, and that is significant. What is much more significant is the governor going out there and saying that next year their GDP forecast is 7%. That's not what the government is betting on. The Finance Secretary, TV Somanathan, told CNBC-TV18 in no uncertain terms that I will factor in 6 point something, that I will not bet on a 7% growth. One of those rare occasions when supposedly conservative central banks are more aggressive in their GDP forecast than the government itself. But we will get to hear more from the central bank. There is, in the non-policy announcement, an important announcement for MSME loans and retail loans, where all the processing fees will have to be declared more clearly, and the banks have been given some time. We will ask the bankers what they mean by this. We have a full house of guests waiting with us, and let me go straight away to, Upasana Bhardwaj. Let me start with the lady. Upasana, what did you make? Extremely even-handed? Are you smelling a stance change? First key takeaways.
Lata, I think a fairly balanced policy. On the top of it, I think he has, the governor has reiterated their focus on attaining disinflation. So I think that 4% target is something which they are very focused on. And when that comes on the backdrop of a kind of upward revision to their FY25 GDP growth forecast, I think that is something which we need to really, watch that very carefully. That space is going to be very crucial, because that also tells us somewhere directionally that markets wherein they were pricing in a probably early change in withdrawal of accommodation stance or in early rate cuts, there is some more room before RBI gets comfortable with that approach. And I would say that H1 looks unlikely to me in this scenario. Growth being very robust, and at the same time, inflation looking benign, but yet not closer to 4. All in all, this is a very balanced policy, no doubt. And the second part is also important, because we were looking at some more clarification from RBI on the liquidity side, but they seem fairly comfortable on the current situation in liquidity. I think that is another takeaway. So don't expect too much apart from the fine-tuning which RBI is already doing. I think that is important, two key takeaways from my side.
Okay. No, I agree with you that they didn't sound that they are giving a liquidity hand over fist. So that brings me to Mr. Ashwini Kumar Tewari, the Managing Director of State Bank of India. Sir, good morning. Thanks for joining. What did you take away in terms of, I mean, do you expect deposit costs to fall? That's one. And have you understood what he said about the processing fees for MSMEs? It seemed like banks will have to disclose more. I didn't get the entire gist, but if you could enlighten us.
Yeah, so two things. One is the policy was on expected lines, as has been said by others also. Nobody was expecting any changes. The important thing is that he made it very clear that even though inflation has come down, but the policy will continue to focus till it comes durably back to 4%. And also he mentioned about the fact that the rate hike which has been done is still working through the system. Now, for a bank like us, we are more or less there, but still, if the governor feels, then that means there are some institutions or areas where the rate is still could do with a bit of change. That is on the interest rate side. The second part is the MSME interest rates and the key charges. Actually, if you recall, in December or a little earlier than that, the RBI had clearly said that whatever rates are, whatever charges are to be levied, penal charges, etc., they have to be now. They can't be put on the main rate. They have to be put separately as a charge. So all of us have started doing that. Parallelly, there are other processing fees in MSMEs cases like upfront fees for term loans and processing fees for working capital. These are always disclosed separately. But I think now he wants in the key financial statement or the key statements that a consolidated rate also the borrower should get some idea that if all this is added up and converted to a rate, what would it look like? And of course, disclosing everything separately. That's my sense, but I would look at the fine print when it is published shortly to see what exactly it means.
Can you clarify a little more? At the moment, processing fees are not revealed separately. I mean, if they're rolled into the rate, then the rate will increase, right? The rate that the customer pays. Fees are not stated separately now?
No, they are stated separately. So what happens today is that the interest rate is stated separately and all fees are disclosed separately. Now, the borrower may or may not get an idea about what exactly is the consolidated rate, because these fees are levied not one time. They are levied every year for working capital at least. So, and there are documentation charges, there are other charges. So just to get an idea as to what a consolidated thing could look like, that's my sense. But I would still say, let me read the whole thing and then come to a final version.
Yeah, I agree with you, sir. But this doesn't change, make life any easier for MSMEs. It is just more disclosure.
More disclosure, maybe more understanding for them. We haven't seen this as
on your part.
Because we haven't seen this being too much of a problem in our case, because we've been it's okay, but we'll disclose that. Yeah.
But immediately, what is your sense about the cost of both deposits and loans? Since the governor says the 250 basis points of rate hikes have not been transmitted, are you expecting loan rates to go up? Separately, are you expecting deposit rates also to go up?
So deposit rates have been going up, as you well know, because there is clearly a pressure on the deposit rates from the sheer growth in loans, and the loan growth rate has been higher than the deposit rate growth by several for the last several quarters. So therefore, even as the loan growth is higher, and secondly, the movement towards equity markets and mutual funds, which have been very strong in light of the strong market, has put a lot of pressure on the deposit gathering and therefore the deposit rates. So that is, in a sense, not related so much to the monetary policy. It's a function of demand of loans and also a function of alternates available to the people. And secondly, on the loan growth, what has happened very recently is the external benchmark, the T-bill rate has gone up by about, I think about 10 to 12 basis points. There is some movement happening there. Again, it is maybe a function of temporary liquidity at the shorter end, and he alluded that the short-term rates have been volatile. So therefore that has been happening. I don't think it's entirely not passed through. It's simply because liquidity fluctuates, and therefore the short-term rate could fluctuate.
Okay. So short point deposit rates can still go up.
Yeah. Yes.
Okay. No, I mean, there are a lot of people who are waiting to lock into higher deposits in case people thought it is peaking off. But your estimate is that there can be further increases in deposit rates. Thank you very much, Mr. Tiwari, for your initial comments. Is there anything else you want to add on the policy?
Nothing. I mean, I think the other announcements also are more in terms of providing more flexibility to the additional measures, more flexibility in various areas, including gold hedging, etc. Policy is on very expected lines, and we are seeing very good growth, not only overall, but also in terms of the corporate segments. So I think this policy is supportive of that. And as long as the policy is stable and predictable, I think that's what the industry and the banks and everybody wants. So I think in that sense, it's a good policy.
Fair enough. Fair enough. Thank you. Thank you very much, Mr. Tiwari. Let me come to the two people who have to decide the price of money. So I have Shobhit Mehrotra and R. Shivakumar with me. Shivakumar, let me come to you first. Did you get any sense at all that yields are likely to recede? I mean, I couldn't get a very strong sense in terms of dovishness, but what's your takeaway?
Hi, Lata. So I think very fundamentally, the RBI says, look, inflation is coming down, but it is not further disinflating from where we were in the existing trajectory. So if you look at their 1 year forward CPI projection, clearly after a low in the September quarter, they're expecting for the next 2 quarters, the CPI inflation will go back to about 4.6, 4.7. So they're not expecting any further disinflationary pressures under the current stance. They want to see some amount of disinflation. So without that, we don't expect anything major from that. The second thing is growth, both in India and overseas.
Shobhit, yeah. Sorry. I wanted the first thoughts from Shobhit also. Did you get a sense, Shobhit, that he may be keeping liquidity at enough so that the call is at 6.5? Are you getting any sense that yields have peaked?
So, Lata, good morning. On liquidity, really speaking, I would have expected something more to be done. This was an opportunity where, RBI could have maybe tweaked the framework a little bit to provide better frictional liquidity for the system. Because what is happening is the yield curve has become flat to inverted. 1 year T-bill yields, 3 months to 1 year T-bill yields are above 7, and you have the 10-year also at 7.10. So this was an opportunity to correct that a little bit by giving more confidence and providing more systemic frictional liquidity to the system, and that could have helped to bring down shorter end rates on a more stable basis. We are seeing too much of volatility in overnight rates, and that is never too good for the markets. But yes, medium to long term yields would be driven by demand supply, and the supply has significantly come off because of the lower fiscal deficit target for FY25. Demand is going to remain strong. So longer term bond yields, yes, definitely will be headed lower, but I think it will take a wee bit longer for that to happen. It's just that market was expecting a little bit to be done on liquidity, but from that point of view, it's a little bit of a disappointment.
Okay, Kaushik, are you disappointed as well? The governor on liquidity said that their statement on withdrawal of accommodation should only and only be read in the context of inflation prevailing above 4% and monetary transmission not being complete. How did you read between the lines? Not much else said apart from the fact that, RBI will be nimble and swift in managing liquidity day to day.
So hi, I mean, this is exactly in line with what I was expecting. You heard me before the announcement. What I was expecting, I didn't expect stance to change, and I clearly made the point that if RBI changes the stance, it is not just related to liquidity; it is also related to rate. So that in one way would be giving a signal that RBI is ready to cut rates sometime in the next few quarters, which RBI probably doesn't want to indicate at this stage. So I'm not at all surprised by keeping the stance unchanged. Now, couple of nuanced points that you need to consider. Governor Das mentioned that they'll use appropriate mix of instruments for liquidity management, not just for frictional liquidity, but also for durable liquidity. I think that's a very significant statement. So they are also talking about that if it is needed, we will use the instruments for durable liquidity management. And what are the instruments for durable liquidity management if you have to infuse? CRR cut could be one of the options to infuse durable liquidity if it is required, or OMO purchases. I don't think OMO purchases would be done, but if there is some durable liquidity management, either you'll have the VRR kind of things for a longer tenor maturity. Above 14 days is considered, a durable liquidity related, instrument, or instrument like CRR. So come April, you could have a CRR cut if RBI wants liquidity to improve and they're going to change the stance to neutral. So that is one thing to look out for. The other thing which I would say a little dovish this time, if you see on the rate front, 5 people have voted for unchanged rate, but Professor Verma has also voted for, a cut of 25 basis points in the policy rate. So this is not similar to the 6 unanimous, decision on rates remaining unchanged. So a little bit of dovishness which has come in from the rates front. Obviously, majority is saying no change, but one person has said, and going forward, you could have more people asking for rate cuts. Remember that the non-RBI MPC members, their term ends in August or September. So the last policy they will be around is for August, and after that in the October policy, there'll be new set of non-RBI MPC members who will come in. So I would expect, before the 3 non-RBI MPC members leave, there would be some rate cuts either in June or August. And if that has to happen, then before that, there has to be a pivot in April. It could be in the form of change of stance or liquidity being brought in through CRR cuts. And the final point that I would like to make is, if you look at the last 2 February policies, last 2 years. So last year, February, RBI hiked interest rates for the last time, but market was convinced that in April, RBI will hike once more, and RBI came and paused and surprised the market. In the previous year, 2022, RBI was very dovish in February, but then the war started, and April, nobody was expecting an increase in the SDF rate or repo rate, and RBI came and increased the SDF rate or the reverse repo rate. SDF rate RBI increased. So I'm saying RBI has the potential to surprise in April compared to what they have said in February. So looking at the past 2 years, so I would say April would be a good time to expect maybe a change in stance and some more liquidity measures through the form of durable liquidity like CRR cut. And then June could be the time that when RBI could look to start cutting rates.
Sure. Upasana, do you concur with what Kaushik is saying? And if you focus on the sentence that they want to deploy an appropriate mix of instruments to modulate both durable and frictional liquidity, are you expecting a pivot, at least as far as the stance is concerned in April, and also the use of instruments like Kaushik was saying, CRR, OMO in the future?
See, all these tools are clearly open. They are there on the table. But my view is that they will not need to use such kind of tools, at least through, let's say, Q1. And that is the reason I don't expect much of a change on stance in April. I think there's a higher probability of a change in stance coming in June. And the reason I say is, as per my own liquidity projections, we will be seeing about a deficit of about 0.5 to 0.75% of NDTL as deficit as we approach end of March. And that in itself should be providing much more comfort to RBI that there is no need to really provide any such structural measure on CRR or so. So I think naturally with government spending, FPI flows coming and some kind of need for RBI to intervene on that account, although maybe not aggressively, yet all of this should provide some kind of leeway for RBI to stay off from such structural tools. So I would refrain from a view wherein a need for CRR cut remains in the near term.
Okay. Upasana, even I don't think this sounds like a Reserve Bank which is going to give a CRR cut. It's just about sounding so even-toned. I find it very difficult to believe that they will be even contemplating a CRR cut at this juncture. They may give OMO purchases to provide liquidity, but they have the repo. I don't smell a CRR cut over here, but let me toss that to the other bond market experts. See, I'm looking at 2 things. As Kaushik correctly pointed out, he has said that they will deploy a mix of instruments to answer both durable and frictional liquidity. And plus, he says, look at my stance as a means to control inflation and to ensure that the rate hike is passed on. So I will provide liquidity, but don't confuse that with a stance. That seems to be the message he's giving. He could be providing liquidity through an incremental CRR cut and not just a CRR cut. It could be only through an OMO purchase, of bonds, or it could be through repos. Every time he does a 2.5 lakh crore repo, we should not smell a change in stance. I think that is the message he's giving. But I could stand corrected. Shivakumar, would you say from his statement that we will deploy a mix of instruments for liquidity, from now to the next policy, you expect call to be closer to 6.5 and not 6.75? Would you say that?
I'm not sure whether RBI is giving that kind of a signal in the very short run. I think the larger picture they're saying is, remember, we are getting 2 lakh crores of flows related to JP Morgan index inclusion this year, right? Or next year. So you will see huge amount of inflows. And the easiest way that they can add durable liquidity is just not sterilize that, right? So don't do any OMOs on this side to manage that liquidity. So straight away that liquidity comes into the system. There is going to be the need for like around 3.5 lakh crores, 4 lakh crores of liquidity addition next financial year. There's no question about that. Out of that, 2 lakhs plus will come from this JP Morgan related flows. So we still need somewhere in the range of 1 to 2 lakh crores of excess liquidity that the RBI will have to figure out some way of infusing. And one statement that the governor has made in the past is, when the withdrawal of accommodation stance is there, don't expect OMO purchases. So I think it'll either have to come from CRR. To that extent, I agree with Kaushik, but I think that the stance will change sometime in the next.
Okay. We'll try and clarify that in the press conference. My sense is, if he meant those instruments to be deployed for durable and frictional liquidity with an eye on the JP Morgan flows, he can do that in April. The flows are coming June end. So he has one clear policy before that. My sense is he's probably hinting that he may give liquidity for the frictional mismatches. Don't confuse that with the stance. Maybe that's what he's saying. We'll clarify that in the press conference. Shobit, anything you want to enlighten on this point? Do you get a sense that because he has said he will deploy multiple instruments, maybe he intends to keep the call rate closer to the repo rate now? Is that a takeaway you can go with at all?
Yes, I think if you look at RBI actions over the course of last several weeks, by announcing both VRRRs and VRRs sometimes twice in a day, the intent seems to be clear to try and keep the overnight rate as close as possible to 6.5. The only issue I see is that volatility still persists. I think market would want a more stable liquidity policy. At this stage, it seems, we are experimenting with something or the other to try and get to 6.5 on the overnight on a regular basis. But, a more stable policy and direction or signal to the market would have helped, to price everything off the overnight rate, and that would have helped along, not only for the yield curve, but it would have also helped for monetary policy transmission. So, that's what was an opportunity which could have been utilized in today's policy, but maybe it's been left for some other day, or maybe the next policy where RBI would do a little bit more on liquidity.
Kaushik, if I may come back to your statement where you said, perhaps a pivot in the stance in April and maybe the window for a rate cut in June. But, the governor's time and again reiterated that until we get to that 4% CPI on a durable basis, and I'm emphasizing on durable, because if you look at the forecast, apart from the second quarter where he's projecting 4%, inflation is again expected to rise marginally to 4.6, 4.7 in the next few quarters. So, does this push your expectations of a reversal, in this calendar year at least?
Talk about achieving 4%, it doesn't mean you need to come to 0.4% on a durable basis continuously. The point is whether the trajectory is aligned to come towards 4%, which will definitely happen in July, September because of the base RBI has given a forecast of 4%. I think it will be lower at 3.7% in that quarter because last year we got a big spike in July, September. But that is not how monetary policy is conducted just by looking at the next 2 months number or something. When you come to June, the thing that you have to think, first of all, is from a forward-looking point of view. If you are confident that your inflation would be around 4.5% and your policy rate today is at 650, the effective market rate is even higher at times at 675. So you're talking about 250, 275 basis points, real interest rate on a forward-looking basis. And is it, something which India needs, given that, current account is more or less stable, rupee is at a very, stable level? Do we need to keep 250, 275 basis points real rate positive? And if you have inflation at 4.5, is 100 basis points real rate good enough, which RBI has indicated in the past that in this cycle, 100 basis points positive real rates is good enough for macro financial stability. In that case, the rates can come down. And the last point is when you come to June, you're not thinking about just the next quarter ahead, what the numbers would be. You're thinking about 1 year ahead. How will credit growth look? How will growth look? How will inflation look if we don't do anything on the policy? Is it possible that growth would be slowing down much more? By June 25, inflation would be coming down if we don't do anything. If you think that will be the case, that credit growth would be coming down quite sharply because of all the measures that RBI has taken and still continuing, then you start the process from June. You don't wait till the end of the December period of 24 to start the policy. Then you're already behind the curve. And by that time, I'm sure the global policy cycle will also turn. The Fed would be cutting rates. ECB would be cutting rates. So I think looking at all these factors, June could be a very good time for RBI to start incrementally 25 basis points rate cut. And if they have to do that, then April, I would say, is a good kind of opportunity. It's the first policy of the fiscal year with the MPR report and everything coming out with projections to at least change the stance and bring about some bit of liquidity into the system if it is still tight by then. Remember, the long-term trend of CRR is 4%. It's not 4.5%. 50 basis points is increase which RBI did in 2022. I think it has room to go back to 4%, which has been the long-term trend. So from that standpoint, April there could be a rate cut from CRR and stance change, and June there could be a repo rate cut. Jan Verma has already voted for a repo rate cut, if you see in the policy.
Yep, that point is taken, but I don't know, the consensus perhaps will not, the majority will not agree for a CRR cut. But the chances of a rate cut later in the year, when you are behind with an inflation number of 3% or 3 point something, is something that can pressure the government, pressure the Reserve Bank. And as well, by then, one would have expected one cut or maybe some cuts from the Fed as well. So perhaps, June is really far away at this point in time. Whether they will change their stance in April remains a very live question. But the important point is, at this point in time, in this policy, they have not hinted that they are preparing the market for a change. The only sentence to which I would cling is what Kaushik pointed out, a mix of instruments for durable and frictional liquidity control. Seems to give the impression that they will do active repos, they will do active, perhaps even OMO purchases, I don't know. But that might be some kind of a sucker. We may see deposit rates therefore not rising for you and me. That's the only hint. Let us see if the press conference gives us any more clarity. The big takeaway from the policy itself is that there is no change in rates, no change in stance, not very clear on whether they're going to be gushing with liquidity and keeping the call at 6.5, but very, very confident on growth. 7%, something which even the government of India is not willing to put on the table. So it's a very aggressive or a very confident growth forecast coming from the Reserve Bank. For me, that would stand as a very big highlight from this policy. That's it on this first initial coverage of the monetary policy statement. Thank you from me and Ritu, and thank you to all our guests. After a break, we will get back to stock market analysis, which has taken a bit of a nosedive after the Reserve Bank's very even-handed policy.
global order, the contribution of the Reserve Bank is getting widely recognized both within and outside the country. The global economy continues to present a mixed picture. On the one hand, the odds of soft landing have increased, with inflation moving closer to the target and growth holding up better than expected in major advanced and emerging market economies. On the other hand, the ongoing wars and conflicts and the emergence of new flashpoints in different parts of the world, with disruptions in the Red Sea being the latest in the series, impart uncertainty to the global macroeconomic outlook. In this unsettled global environment, the Indian economy has performed remarkably well in the recent years. Growth is accelerating and outpacing most of the forecasts, while inflation is on a downward trajectory. At the current juncture, India's potential growth is propelled by structural drivers like improving physical infrastructure, development of world-class digital and payments technology, ease of doing business, enhanced labor force participation, and improved quality of fiscal spending. Our multi-pronged, proactive and calibrated policies on the monetary, regulatory and supervisory fronts have worked well to maintain and strengthen macroeconomic and financial stability. Let me now turn to the decisions and deliberations of the Monetary Policy Committee meeting, the Monetary Policy Committee, which met on 6th, 7th and 8th of February, that is culminating today. After a detailed assessment of the evolving macroeconomic and financial developments and the outlook, the Monetary Policy Committee, that is MPC, decided by a 5-to-1 majority to keep the policy rate unchanged at 6.5%. Consequently, the standing deposit facility rate remains at 6.25%, and the marginal standing facility, that is MSF rate, and the bank rate at 6.75%. The MPC also decided by a majority of 5 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns with the target while supporting growth. I shall now briefly set out the rationale for these decisions. The momentum in domestic economic activity continues to be strong. Headline inflation, after moderating to 4.9% in October, rose to 5.7% in December 2023. This was primarily due to food inflation, mostly vegetables. The softening in core inflation, that is CPI inflation excluding food and fuel, continued